Hey there, Ed McCormack here, founder of the crypto education platform Dchained. Today's video, I'm going to be talking about one of the most controversial, most widely debated topics when it comes to crypto today, which is the futures market. Now, the futures market has become a bit of a double-edged sword when it comes to crypto. It's opened up a whole new wave of institutional investors, but at the same time, it introduced a whole new wave of challenges for investors and ultimately has raised questions about potential price manipulation, especially as it relates to Bitcoin. So we'll start off first by talking about what are futures. And very simply put, futures is a contract that is traded between a buyer and a seller where an asset is going to be offered at a certain price at a date in the future. So for example, if you are buying the future and you want to go long, so you're going to purchase the call, you are going to say, I am willing to pay whatever that price is. Usually it's a little bit higher than what the current price is on the spot market or when you just buy Bitcoin regularly. And I'm obligated to purchase that Bitcoin, that asset, when that date arrives, when this contract ends. It's called an expiry. And when the purchase occurs, it's called a settlement. Now, on the flip side, it works the same way. I can also decide that I'm willing to sell my underlying asset, Bitcoin, and at a certain price to the buyer, regardless of where the price is at that current time. Now, pretty simple enough. It's something that has existed for a very, very long time, and it's quite frankly the largest market in the world. It far exceeds the overall value of the traditional New York Stock Exchange, the London Stock Exchange. There are figures out there that put it into the trillions and trillions of dollars, the value of this overall futures market. And it's something that you will find for commodities, for precious metals, for stock, and more recently it's come to the crypto market vis-a-vis Bitcoin first, but also more recently with the largest exchange, CME Group, now introducing futures for Ether. So why is that a real negative thing? How can that be bad? Well, I'll answer that question for you. So it really comes down to a few different underlying factors. And to help explain it, I'm going to focus more on Bitcoin because it's been around for a while. And it's also the asset in crypto that gets the most attention as it relates to futures. So when talking about how Bitcoin futures could be a negative to the overall crypto market, you have to look at a few things, such as how those futures are being settled, the sensitivity to spikes in demand, and ultimately volatility. Those three things: settlement, sensitivity to demand, and volatility. And I'll talk about those right now. So when you exercise a future, when you buy into a market, you often will go to one of the two biggest exchanges out there. You have CME Group, which is the Chicago Mercantile Exchange, or CBOE, which is the Chicago Board Options Exchange. Now, these two account for the lion's share of all futures trading worldwide, and both of whom have offered up futures related to Bitcoin. Now, the reason I bring this up is that the way that they actually operate is a little bit different than how most people buy Bitcoin today. If you were to go on Coinbase or whatever exchange that you prefer, you would take your money and you would buy Bitcoin. You would just take your cash and turn it right into Bitcoin. It's not exactly how it works, though, when it comes to futures in these regulated exchanges. How it works is you take your money and I am going to agree to purchase Bitcoin or sell Bitcoin at a later date at a certain price, with everything being settled in fiat, so in the US dollar or the euro. And that becomes an issue because in this process where I'm purchasing the contract with cash and I'm settling it with cash, there's actually no Bitcoin that is owned throughout this process. And that becomes a major issue because if you think about really the economics of Bitcoin, it really centers around the concept of supply and demand. There's roughly just under 19 billion Bitcoin that's currently in circulation. There's a cap of 21 million, that'll ever exist. And beyond that, that's where sort of the price elasticity comes into play. As demand goes up and there's a fixed supply, prices go up. As demand decreases, prices go down. If you're never actually owning the actual Bitcoin itself, and all you're creating with these bets that you're doing, on the futures are just paper Bitcoin or synthetic Bitcoin, ultimately creates a scenario where, there's an unlimited amount of people who could actually put in sell orders for an asset that they don't own. Now, ultimately creating an artificial wave of negative sentiment and sell-off on an asset that by nature is very price sensitive to overall demand, whether the demand is up or down. I'll give you an example. So Bank of America in March of this year, of 2021, put out a report really analyzing the volatility of Bitcoin and really looking at how much money, either from an inflow or outflow perspective, would be required to move the price of Bitcoin by 1%. And to a lot of people's surprise, it's not that much money. It's only about $93 million to move Bitcoin 1%. Now, for your average retail investor like you and I, $93 million is, and I'm going to go on a limb here, unfathomable. Something that is not, what we generally trade on a day-to-day basis. But in the institutional world, the world of Goldman Sachs and Morgan Stanley and these big banks, they deal in hundreds of billions a day, if not almost trillions a day. So for 93 million, it becomes a very lucrative opportunity to start looking at certain types of trades that might put you on an opportunistic end of that futures contract. I'm going to tell you a little bit about what that means now. So in a previous video, we talked about a way that you could use a futures contract as a hedge and as a way to get that little premium between what you purchase the asset for and what you are actually going to sell that asset for on the futures. And it's usually, roughly 8 to 12% is what you could probably expect on, a large asset like Bitcoin. But that's not really the issue here. The issue, and what's drawn a lot of people to start to point to futures contracts as the source of price manipulation when it comes to Bitcoin, is a practice that has been widely criticized in the equities world, especially bringing attention on firms like Goldman Sachs, is a practice called banging the books. Now, banging the books just simply means that you are waiting until just before the expiry, just before that expiration hits on that contract to flood the market with either a bunch of buy orders or a bunch of sell orders. And what that creates for, specifically for an asset that's really sensitive to, these big inflows or outflows, as I just said, it only takes $93 million as of March to move Bitcoin 1%. It creates a scenario where you could artificially push that price down to ultimately help you settle more favorably on your futures contract. So think about this scenario, okay? Let's say you are an institutional client, okay? So you work with Goldman Sachs, and Goldman Sachs puts in a big order, to short Bitcoin in the futures market, at the end of this month. Well, as the price gets closer to that last day of the month, in June, it's going to be June 25th is the expiry date, Goldman Sachs is incentivized to say, well, if we have $2 billion in futures contracts where we're shorting the price, and we also can benefit now because we've agreed to pay at this premium, we benefit significantly if the price is lower because the other side of this trade, the buyer, has to pay the premium regardless of where the price is. It's in our best interest to maybe take now $2 billion, so your counterweight, and put that into selling off Bitcoin on the current spot market. What that will create, and let's round up that 93 million to 100 million for even numbers here, you would expect a 20% drop now in the price of Bitcoin from just $2 billion being moved. That sounds like a pretty terrible situation if you're a retail investor because you're eating a 20% drop. But if you're the institutional, you're high-fiving all your other friends in the finance world because guess what? You are getting paid at that top premium price, and everything that drops below, especially that 20% that you just artificially caused, that's all extra profit. So that's a great trade, for you. And this is something that's now starting to happen more and more, especially as more institutional investors come into the market and see how sensitive Bitcoin is. To help draw a comparison to this, if you looked at what it would take to move gold by 1%, it's roughly $2 billion. Looking at a bigger asset like US Treasury, it could be tens if not hundreds of billions of dollars to move it 1%. So it's inhibitive at, given the size of those assets, to try and execute this type of strategy. But for a relatively immature asset like Bitcoin, it's a very smart and prudent move if you're an institution. So thinking about, how you can now start protecting yourself, I want to mention two things here. One is you need to be mindful of the two ways that these futures contracts are bought and sold. It's either done on a monthly basis or quarterly basis. And where it gets really tricky and quite frankly, very dangerous is the last date of settlement of every month. Usually it's the last Friday of the month for the last day of the quarter. So we saw it was March 26th when the first quarter expiry concluded, as well as the month of March concluded. Sort of a double whammy. And what investors faced was roughly about a $6 billion sell-off, which was massive. Skipping ahead to now, we're looking at June 25th as the expiry date for both the month and the quarter over the last 3 months. It's a slightly lower number as of today, which is June 4th. We're looking at about 1.6 billion. So again, about a quarter, give or take, of what we were seeing in Q1. But it's also something you should be mindful of because there have been report after report after report that have shown a direct correlation between the price of Bitcoin plummeting around the days of these settlements for these futures contracts. So keep a close eye on when the end of month and the end of quarter are going to hit. Maybe look at trying to shift towards a capital preservation strategy on that last month of every quarter, because again, we don't know how these contracts are ultimately going to settle, whether people are going to start buying into Bitcoin heavily on the market, on the spot market. That could potentially counterweigh all that sell-off. But again, it's better to be safe than sorry. So just keep a very close eye on when those dates are happening, and also keep a close eye on how the market is reacting. You'll start to see a lot of coverage, especially in crypto publications and crypto sites. But make sure that you mark that day on your calendar. It could either cost you or make you quite a bit of money. So I hope you enjoyed this video. If you did, again, subscribe to this channel, I should say, like this video, and come check us out at Dchained.com to find out more information, just as the futures market, and learn a little bit more about what other coins, what other strategies could potentially help benefit you in your crypto investing. So please come back, join us again, and happy investing.